Hello, Sam McGee, CEO of Crestmont Private Wealth. And today we're going to be talking about the U.S. interest rate yield curve. A bit of education for those out there that have seen what's been happening at the Fed and to make sense of it. So taking a look at the screen here, on the right-hand side, you'll see the U.S. yield curve. And on the lower axis, you have a 1 month, 6 month, 2-year, 5-year, 10-year, and 30-year plot of the prevailing rates of the US debt. So then above that, you can see the various points in time that are color coordinated based off of now in blue, a week ago in green, red a month ago, and 1 year ago in yellow. Given that it is June 2022, a lot has happened in the last year. What you can see is that a year ago, we were effectively near a 0% interest rate environment on the short-term side of things, but the 30-year rate was hovering between 2 and 2.5. Today, a lot has changed. The Fed has started raising rates to combat inflation, and as you can see, we have a very steep yield curve going out to about the 5-year mark, and then it is actually inverted from the 5 to 7-year mark. So a little bit of education on that. When the Fed is raising rates to try to either cool off the economy or look to combat inflation, they hope to be successful in that, in balancing the effects of keeping the inflation tamed, but also the economic environment stable enough for continued growth. Now, that's a challenge, obviously. Taking a look at this does not mean that just raising rates and the US economy being cooled off or the equity market taking a bit of a correction is all bad. So on the left-hand side, we list pros, cons, and silver linings. Some of the pros here: CD rates are certainly a lot higher from a year ago, much different. Bond yields are now higher for bond investors and those that have portfolios that have allocation to bonds that are making new investments. Those are a lot better prevailing rates than what they were a year ago. Savings and money market rates. Now, this is depending upon the bank. Some banks have been raising their rates and informing their deposit holders. Some have not. So it really depends on which bank you're with and what their strategy is. So keep an eye on that. Some of the cons: mortgage rates are definitely higher. Those that are looking to apply for a mortgage, it's a much tougher rate environment than what it was a year ago. And lump sum rates are higher for those that have pension lump sums, meaning as the discount rate goes higher, the value of the lump sum typically is going to go down. Does not necessarily mean it's a reason to retire. However, it is something to keep an eye on. Silver linings: there's better solutions for interim risk management with higher internal rates of return on fixed income and annuity and CD solutions. So that is a good thing. Another silver lining that we've seen from this recent jump in rates is this is the US yield curve. Now, the global yield curve looks a lot different, further illustrating the point of global diversification in a portfolio. Thank you for watching this video, and if you have any questions, please contact us at info@crestmontpw.com.